All right, everyone, let's break down these two crucial bearish reversal candlestick patterns, the shooting star and the hanging man. First and foremost, you must remember that both of these are bearish reversal signals, meaning they suggest an uptrend is about to reverse into a downtrend. They look very similar, a small body at the lower end of the candle's range and a long upper wick or shadow. The key difference is the context. A shooting star appears after a clear uptrend and acts as a warning sign that buying pressure is weakening at the highs. The hanging man also forms during an uptrend and signals that sellers are starting to step in. Now, here's the most critical rule that many traders miss. Seeing the pattern is not enough for a trade. For both of these, the signal is only validated when the low of the shooting star or hanging man candle is broken by a subsequent price candle. This confirmation is a must. Without it, the pattern is just a potential warning, not a confirmed signal. So, how do you trade it? Once you get that confirmation, you can place a sell limit order at the 50% retracement level of the pattern's total range, that is halfway between its high and its low. This allows you to short a potential pullback for a better entry. A final, vital piece of advice from this chart. These patterns are most reliable on higher time frames. You should only use them on the H4, 4-hour, D1, daily, or weekly charts to filter out noise and get higher probability signals. Just as the shooting star and hanging man warn of a potential top, these two patterns signal a potential bottom in a market. Both are bullish reversal patterns that appear during a downtrend, indicating that sellers are losing control and buyers might be stepping in. The hammer has a long lower wick, showing a strong rejection of lower prices, while the inverted hammer has a long upper wick, hinting that buyers are starting to test higher levels even if they got pushed back, and the golden rule remains the same. The pattern alone isn't a green light to buy. For both the hammer and the inverted hammer, the signal is only valid once the high of the pattern's candle is broken by a new closing candle. This is the essential confirmation that buyers have truly gathered enough strength to push past the pattern's peak. Once you get that confirmation, your trade strategy is straightforward. You can place a buy limit order at the 50% retracement level of the pattern's range, aiming to catch a slight pullback for a better entry price. Crucially, you must protect your trade with a stop loss placed below the low of the hammer or inverted hammer. And remember, for the cleanest, most reliable signals, stick to the higher time frames, H4, D1, or weekly charts. Using these on lower time frames can lead to false signals and whipsaws. Now that we've mastered some key reversal patterns, let's build our chart knowledge further by understanding a powerful charting phenomenon, the gap. In its simplest form, a gap is essentially a void or a blank space on the chart between two consecutive candles. This happens when the closing price of the previous candle and the opening price of the current candle do not match up. There's a clear jump in price with no trading activity in between. You'll typically see this in two forms. A gap up occurs when the market sentiment is so overwhelmingly bullish that the next candle opens significantly higher than the previous candle's close. Conversely, a gap down happens when bearish sentiment takes over, and the next candle opens sharply lower. It's crucial to understand that when the opening price of the current candle is the same as the closing price of the previous one, there is no gap. The price action is continuous. Gaps are significant because they often represent a sudden surge in buying or selling pressure and can act as major areas of support and resistance. A gap up can become a future support zone, while a gap down can become a future resistance zone that prices may struggle to get back above. While we've focused on high time frame patterns like the hammer and shooting star, gaps are a concept that applies across all time frames, though their significance is often greatest on the daily and weekly charts where they can signal major fundamental shifts. We're moving into some more advanced but incredibly powerful concepts now. This image builds directly on our knowledge of basic gaps and introduces two key ideas: the hidden gap and how these areas can act as a marker for a pullback. You remember a regular gap, that clear void between candles. A hidden gap is a bit more subtle. It's not a gap in the traditional visual sense on the chart. Instead, it's a gap that forms within the range of a single candle or a small consolidation zone, often identified using specific indicators or concepts like the WBR mentioned here. The note points out that price don't respect to it when going down, meaning that during a strong downtrend, the price might blow right through a hidden gap level without reacting. So if it's not always support or resistance, what is its purpose? This is where the real utility comes in. The chart tells us it can act as a marker for pullback. Think of a hidden gap not as a wall that will stop price, but as a magnet or a milestone. After a strong impulsive move, the price will often pull back or retrace. A hidden gap area acts as a high probability target for where that pullback might end before the main trend resumes. It gives you a specific zone to watch for your next trading opportunity. Whether that's adding to a position or looking for a reversal pattern like the hammer or inverted hammer we discussed earlier. The bottom line is this. While a regular gap is like an obvious pothole in the road, a hidden gap is like a hidden drain cover. You might not see it easily, but when the market pulls back, it often drains momentum right at that level, making it an essential marker for any serious trader. Now we're getting into the real mechanics of a trade setup. This chart brings together everything we've learned and adds two powerful tools, Fibonacci retracement levels and the concept of an inside bar false breakout. First, let's look at the Fibonacci levels drawn on the chart. You see the 0.0, 50.0, 61.8, and 100.0. These are not random numbers. They are key ratios used by traders worldwide to identify potential support and resistance levels during a pullback. After a significant price move, traders use the Fibonacci tool to draw from the high to the low, or low to high, of that move. The 50% and the crucial 61.8% levels are where you often find buyers stepping in during an uptrend pullback or sellers returning during a downtrend pullback. This connects perfectly to our earlier videos where we placed our entry orders at the 50% level of our candlestick patterns. Now you see the bigger picture. We're often aligning our pattern's 50% level with a major Fibonacci level, creating a high probability sweet spot for entry. Now, look at the candle marked as an inside bar false breakout. An inside bar is a candle that trades completely within the high and low range of the previous candle. It's a sign of consolidation and indecision. A false breakout occurs when price breaks out of this consolidation but then quickly reverses and moves back in the opposite direction. This is a classic trap for impatient traders. So, how does this all connect? Imagine this scenario. The market is in a downtrend. You see a bullish hammer pattern and its high gets broken, confirming the signal. You look for an entry on a pullback. That pullback could find support right at the 50% or 61.8% Fibonacci level. And if you see a small inside bar form at that level, followed by a false breakout to the downside that immediately reverses, that's your triple confirmation. It tells you the pullback is likely over and the bullish reversal is ready to continue. This chart is teaching you to be patient, to wait for these confluences of price action, pattern, and indicator levels to line up, dramatically increasing the odds of a successful trade. This candles brings us to the single most important lesson that ties every single one of our previous videos together. The absolute necessity of confirmation. We've mentioned it with every pattern. The hammer isn't valid until its high is broken. The shooting star isn't valid until its low is broken. This chart drives that point home visually. You can see a perfect shooting star pattern, but if you act on it immediately, you're taking a risk. The very next candle is what we call the confirmation candlestick. It's the candle that closes beyond the low of the pattern, validating the bearish signal. This is what we label confirmation close. It's the market giving you the green light. Conversely, the chart shows us what happens when we don't get that signal. If the price moves away from the pattern without breaking its key level, we have no confirmation. The pattern has failed and the original trend is likely to continue. In technical analysis, we use patterns, indicators, and Fibonacci levels not as crystal balls, but as a framework for probability. The confirmation candlestick is the objective piece of evidence that tells us our hypothesis is likely correct. It's the difference between guessing and trading with a plan. The first strategy is entry at open. This is a more aggressive approach. As soon as you identify a potential reversal pattern, like a shooting star at the top of an uptrend, you don't wait. You place an order to enter at the open of the next candle. The logic here is that the mere formation of the pattern shows a shift in momentum, and you're jumping in early to capitalize on it. The benefit is that you get a better entry price if you're right. The risk is that the pattern might not confirm, and you could be entering a false signal. The second, and more conservative strategy, is the entry at break. This is the method we have been emphasizing throughout this series. Here, you patiently wait for the confirmation we just discussed. You only enter when the low of the shooting star is broken by a subsequent candle. This is the classic disciplined approach. You are sacrificing a slightly worse entry price for a much higher probability of success, as the market itself has now validated your thesis. So, which one should you use? It often comes down to your risk tolerance. The entry at open is higher risk, higher reward. The entry at break is lower risk, as it requires proof and is generally more reliable. As the note suggests, these standard entries are the final step, built upon all the analysis we've covered, the price action of the candlestick patterns, the trend lines of the overall move, and the support and resistance levels like Fibonacci and gaps. Your entry is the trigger pull, but the target should already be set based on the confluence of all these other tools.